Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. This week, I came across a fascinating interview Reuters conducted with Nikolai Tangen, CEO of Norges Bank Investment Management, the world's largest sovereign wealth fund. When asked what the biggest risk to financial markets was today, he responded, decoupling, the fragmenting of the world economy. You are in a situation now, he said, where you have a hot war, you have a cold war, you've got a trade war, you've got a tech war, and it leads to lower economic growth, higher inflationary pressure, and more uncertainty. In the fund's stress test scenario for a fragmented world, Mr. Tangen said his fund could lose up to a third of its value. Wow. Well, this week our three things are: 1. Complacency. It's back. 2. Trade progress. What's the evidence? And 3. European appeal. It's become a fashionable trade. Our European counterpart weighs in. All right, let's dig a bit deeper. Complacency. So this week, a story we saw everywhere all the time was that the S&P 500 is right back to where it was April 2nd, the day the new administration announced its retaliatory tariffs. It's essentially the same story with regard to investment grade and high yield credit spreads. Now, you could argue that there was plenty of pre-announcements of tariffs that drove sell-offs in risk assets ahead of that official day, so we're still at levels weaker than where we were on election night. But a commonly held view is that we've repriced a bit, maybe we've removed some of the froth from risk valuations, and now we're settling into a more defensible trading range. Not so fast. Before we breathe a sigh of relief, there are at least two formidable issues investors will encounter in the near future. 1, the actual effects of the trade war, and 2, market reaction to the debt and deficits, which are about to take center stage as the administration's tax cut plans are rolled out. On point 1, the effects of the trade war, it takes time for those effects to materialize. Realistically, this will take place over the next 3 to 6 months, although press reports coming out of the meeting last week between the White House and the CEOs of Walmart, Target, and Home Depot warned of empty shelves within weeks, and soft data such as this week's decidedly weak Dallas Fed manufacturing survey reflects businesses' mounting concern about deteriorating business conditions. On point 2, the White House has set July 4th as the goal for passage of a multi-trillion-dollar tax cut package, the GOP's top legislative priority. The plan calls for making permanent the Tax Cuts and Jobs Act, the TCJA, as well as additional cuts campaigned on, including no tax on tips, no tax on Social Security, no tax on overtime, making auto loans deductible, and allowances for writing off the cost of building factories in the U.S. The fiscal initiatives come at a time when sovereign debt to GDP has hit an all-time high in the U.S., despite the longest peacetime expansion in history of nearly 16 years, if we exclude the 2 months of COVID-related recession. Enacting the TCJA alone will increase the debt burden substantially, a situation made worse by the fact that interest rates are structurally and materially higher than they were when the debt was deployed massively to deal with the aftermaths of the GFC and COVID. And our future is a debt ceiling battle and debate over the pay-fors, which inevitably will involve the third rail of American politics, entitlements. Volatility may have died down for the time being. We remind investors that it is unlikely to stay that way. All right, on to our second thing, trade progress. Now, we would be the last to say the trade war plan is settling into a predictable place. We know enough to know this is all still, fluid. But there are elements in this story that are better defined. First, we believe trade deals, or at least talk of trade deals, are becoming the dominant narrative coming out of the White House, a change from the rollout shock that consisted of sweeping universal tariffs augmented by the threat of additional reciprocal levies. Of course, we would be well advised to curb our enthusiasm with regard to what constitutes a deal, as opposed to what just might be progress toward a letter of intent, or even more simply, a dialogue. Trade deals typically take years to finalize. But the uncertainty has diminished a bit when we learn, for example, that the EU's trade commissioner says that the US and the EU have made progress through multiple rounds of negotiations. And investors should take comfort in the EU's comment that they, the US, understand us a little bit better and we have a little bit more understanding. That tells us that compromise is still possible. And then there are other motivations that bring parties together. In the US, poor polling results could provide an impetus to act to address the cause for concern. In China, deteriorating economic data, such as its manufacturing output for April, could be the catalyst. And sure enough, there are now reports that the US and China are actually engaged in negotiations. Now, looking ahead, hard data in the US matching the soft data would continue to incentivize the US administration to look for ways to change the narrative and the economic trajectory. And with the threat of those aforementioned empty shelves and snarled supply chains looming, it is in the administration's interest to seek out trade wins. That will surely help polling and economic outcomes, not to mention credit risk premia. All right, on to our third thing, European appeal. Investors have taken a shine to the opportunity in European and UK credit here in Q1, no doubt in response to the changing world economic order. And here to walk us through this story is my colleague, Gordon Kerr, KBRA's European macro strategist. Gordon, welcome to the podcast.
Thanks for having me on, Van.
So we've launched a new quarterly series, The Forward Look, in both the US and UK/Europe versions, with a goal of steering our readers and listeners to what forces we think are the most important ones shaping credit markets over the near term. So let's dig into your inaugural Forward Look. From an investor flow standpoint, Europe has been the beneficiary of the Sell America trade here in Q1, but you point out that the US tariff regime really is a double-edged sword for the UK and the continent. Walk us through the two sides of that story.
Yeah, Van. So you are right. There are two sides to this. First, there's the obvious. Tariffs tend to dampen activity and weigh on growth. And Europe wasn't exactly starting from a strong place with GDP expectations for the year sitting around 1%. From a European perspective, tariffs would hit key sectors like autos and pharmaceuticals, impacting major economies like Germany, France, and the UK. Now, these countries are still likely to be the most exposed, though the US administration appears to be softening its stance on the automotive sector, though that is likely to be more focused on helping US manufacturers than European ones. On the flip side, US policy actions, not necessarily just the tariffs, have prompted a notable reaction in Europe. One example, something most unthinkable at the start of the year, Germany has opened up its fiscal taps. There's been a broader uptick in European defense spending, and the European Commission has launched several growth-oriented initiatives. I wouldn't exactly call it deregulation, that's not very European, but we are seeing a push for at least simpler and clearer rules as a part of their quote-unquote deregulation. Globally, the response to US policies has led to diversification out of the US, and that means that many countries are looking for trading opportunities within Europe. Plus, from a capital perspective, there's been a fresh drive of flows into what had arguably been an undervalued Europe. Why call it undervalued? Well, because as you've pointed out, in the US context, Europe enters this phase from a position of relative strength. Growth may have broadly been muted, but banks are well capitalized, corporate balance sheets are solid, and both energy prices and interest rates have been trending lower. Disinflation has brought Europe closer to target, and importantly, Europe's trade exposure to the US is under 20%, meaning the impact from tariffs should be more limited than you may see in other regions. For the UK, it is slightly more than 20%.
Now, what do you see as the most important factors for credit investors to watch in Q2?
One key area will be sectors most exposed to tariffs. We'll be monitoring for signs of earnings pressure and any uptick in defaults or insolvencies. That said, we don't expect a significant spike. Many firms have already weathered the pandemic, elevated energy costs, and tighter financing conditions. Still, not all companies are equally resilient. Smaller and mid-sized firms, particularly those with tight margins and high leverage, could be more vulnerable to shocks. And these are the names to really watch closely. We're also keeping a close eye on the labor market. Surveys show European consumers are increasingly worried about job security, and the savings rate remains elevated as a result. While we do expect some softening in employment, we believe it will be a gradual decline rather than any sort of a sharp downturn.
All right, so we'll pull all this together for us in terms of the opportunity in European credit. Spreads are relatively tight compared to long term averages. Do you expect them to hold in, or are you looking for risk premia to build?
I hesitate to overquote BlackRock CEO Larry Fink, but he's been one of the most vocal proponents of the pro-European trade recently, from his remarks at Davos to his firm's Q1 earnings call. And I tend to agree with this view. European equities have outperformed and credit markets continue to look compelling. They're not exactly undervalued in comparison to their long-term averages, with both high yield and investment grade both pricing inside of their 10-year averages. But we think they still look interesting given the Sell America movement that you highlighted up front. Looking ahead, the second quarter in 2025 European credit environment is defined by a mix of resilience and emerging pressure points. Stable labor markets, solid earnings, and still attractive fixed income yields provide a strong foundation for investors. At the same time, external risks, especially those tied to US policy and some lingering fiscal strains in the parts of Europe, call for an overall broadly prudent stance. In my view, this is a moment to be cautious but ready to act. The tariff story isn't over yet, and positioning carefully around that uncertainty will be key.
So there you have it. 3 things in credit. 1. Complacency. Before you get comfortable that the repricing of credit risk is complete, we'd remind you that we're not out of the woods yet. 2. Trade progress. You've got to start somewhere, and we're starting to see some signs of progress. And 3. European appeal. Tariffs are a double-edged sword, another headwind to growth, but selectively a worthy diversification play away from the US. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research, including the first installments of our new series from Gordon and myself, The Forward Look, credit insights from, respectively, the US and from Europe, UK. We'll see you next week.